So in this video, I'm going to be going over stock splits, how they work, and basically why a company would want to do a stock split on their shares. So for those of you who are completely sort of new to this concept, the idea of a stock split is basically increasing the number of shares outstanding in a company. So if a company has 1 million shares outstanding, the idea is to basically a stock split of 2 would basically increase the shares of that company by 2 times. So 1 million shares would turn into 2 million shares. So basically, if you're an investor in that company and you're holding 100 shares, your 100 shares would automatically get converted into 200 shares. Now what that does is that it increases the total amount of shares outstanding in a company, but it doesn't actually change the company's cash flows, and it doesn't affect the proportional ownership of any individual investor. So if there's 1 million shares outstanding and you own 10% of that, if the total amount of shares goes to 2 million, you'll now have 200 shares and your proportional ownership stays exactly the same. So now let's sort of go over what the rationale would be to sort of why would a company want to do a stock split in the first place. So we get down to the rationale is basically, since the company's value does not change because of a stock split, the only thing that changes is the amount of shares outstanding. The price following a stock split always decreases because the value of the company is the same, but there's more shares outstanding. Now what that does is it brings the stock prices to lower trading range. So if you have a stock that trades for $100 with a stock split of 2 times the stock split ratio of 2, it brings the share price down to $50. Now this is really good for companies that really want to promote liquidity in their share prices. So what I mean by that is, let's assume that you're an investor that has $100 to invest and you're researching companies that might be of interest to you. Now if you see a company that stock price is $1,000 a share, you likely won't be purchasing that stock at all. But if you see a company that stock price is only $10 a share, you'll be far more incentivized to buy that stock just because it's more affordable for you. Now, companies that stock prices get too high, they attempt to bring down their stock prices, which makes them more affordable for individual investors. And when it's more affordable, more people are likely to buy it, which creates liquidity in the financial markets as well. So now, as always, I have an example here of a company, Berkshire Hathaway. It says that their stock is trading for $120,000 a share, and there's 1.65 million shares outstanding. Now, Berkshire wants to execute a stock split to reduce the stock price to $30. What split ratio would they use? It's a fairly simple question. So before we get into it, I'm going to take you over some of the formulas. So the idea is that the price after a stock split is equal to the price before divided by the split ratio. And I'll explain what the split ratio is. So the ratio of the split ratio is basically taking the amount of shares outstanding after the split and dividing it by the shares before. So like I mentioned earlier in this video, if a company has 2 million shares after a stock split, but they only had 1 million to begin with, it will be 2 million over 1 million, which would give you a stock split ratio of 2. And now, let's say you have now you want to use this split ratio, you know the number of shares, but now you want to see the impact, the direct impact that has on the price. You can go to this formula and see that the price before divided by that ratio is going to give you the price after. So if that same company's stock was trading at $100, you divide that by 2, and that would give you $50, exactly halving the price of the stock. So now going back to this question, so I've just inputted the numbers here just for our purposes. So the price before is $120,000, the price after is $30, and the shares outstanding are 1.65 million. So we need to calculate the split ratio. Fairly simple. We basically need the shares after divided by the shares before, but we don't really have the shares after. We only have the shares before. So this is where sort of you need an intuitive understanding of how this split ratio works, which I hope I was able to give in the earlier part of this video. So we've noticed that the ratio, if you'll notice that the ratio of the shares after and the shares before is going to be the same as the price after and the price before. So we don't really need the stock before or the stock after. Even if this value was not there, that would not really prevent us from answering this question. It doesn't really help us either. So what we can do is that the split ratio can also be written as the price before divided by the price after. And we know that in a stock split, in a regular split, the price before is always bigger and you're going to try to reduce the price. This ratio will always be positive. So if we do that, it gives us an answer of 4,000. Now this should intuitively make sense to you. It basically says that if you have 1.65 million shares, you should take each and every single one of those shares and multiply it by 4,000. So if I'm an investor in Berkshire Hathaway and I have one share out of the 1.6 million, that one share should convert it into 4,000 shares, right? So eventually, if you want to find out the total shares after, and I'll quickly write that out, total shares after, you could simply do that by multiplying the shares before by the split ratio. So the amount of shares after, is actually significantly more. It's 4,000 times as many shares. And with 4,000 times as many shares, the price falls by a magnitude of 4,000 times. So this was basically an introduction to stock splits, how they work. Hopefully this video helps you get a better understanding of why a company executes a stock split and what impact it has on the shares, individual ownership, and the price of the stock.